So hello everybody, good morning, good afternoon, good evening. My name is René, welcome at the market update webinar for European tank storage markets. So this webinar, and I will go directly to the first slide. Let's see if it works. Yeah, to the agenda. So this webinar will last about 30 minutes. And of course, you're free to ask questions via the chat. And then I will answer them after discussing the last slide. But I have to allow some people who are joining. And people come in. So if you send me a chat, then I will try to answer your questions after the end of the presentation. And hopefully we will have some time. After a brief introduction of myself and Insights Global, I will give you an overview of the tank terminals industry. We are reviewing the 2020, an exceptional year, and of course we are looking ahead what will bring 2021 and beyond, what will bring us. I'm a bit distracted because I have to allow all kind of people, which is good, of course. Now going to the first slide. Now, who are we? We are Insights Global. We are a market research company, and we are specialized in the oil, chemicals, and renewables value chain. So we offer all kinds of services, like, for example, ARA stock level, wine barge flows, wine barge freights, and ARA barge freights. And we offer also consultancy services. And in the Oil Academy, we give a 2 days training about the oil industry. So 3 years ago, we acquired tankterminals.com, which is an online platform where you find details of more than 5,000 terminals, almost 6,000 terminals worldwide. A newest feature is the logistical performance benchmarking tool, which will show all kinds of KPIs, like number and type of ships visiting a terminal and berth occupancy rates. Talking about myself, I've been working for many years in the storage and chemical industry, working at Klukner Pentaplast, working for 12 years at Vopak, working several years at Eastman Chemical and 2 years at Otveld Terminals. And last September in 2019, I joined Insights Global, and I'm responsible then for the consultancy services. And as you can see on this slide, our mission is to create better functioning markets to make them more transparent. And we believe that we can contribute by providing actionable insights and consequently help our customers with making intelligent decisions. So our mission is to create better functioning markets to make them more transparent. So as said before, let me go to the we start with reviewing the year 2020. It's almost come to an end. It's an exceptional year, mainly because of COVID-19, but also some other things have happened. And we will review it, and we will also look forward to 2021 and beyond. Before switching to the market update, it is important to discuss the different functions of terminals. First, terminals do have different functions, as most of you most likely will know. We can, first of all, it has a logistical or hub function. So we can distinguish make or break bulk terminals to facilitate import and export of trade flows. We can identify distribution terminals, helping distributors to sell their products in a specific region, mostly using chemicals. Industrial terminals, you can identify them, usually linked with industrial complexes, industrial plants. And terminals, of course, are also used as a buffer stock. Secondly, the large storage hubs act as a trading platform, so in particular for oil products. So for arbitrage purposes, storage is needed. For blending purposes, storage is also needed. For contango storage, you need to store somewhere your oil. Tank storage is very important. And also, if traders speculate or go for optionality storage, capacity is needed. Thirdly, here at the right side, you see also strategic storage as a function of terminals, but we will not discuss this function today. What is important? What are the indicators? How to review terminals? It's about throughput versus tank capacity, or tank turns, you can call it like that. Stock levels are important versus tank capacity, commodity price volatility, commodity price forward, because these are all important factors in this market. So, and the market condition, it depends also on the terminal client's ability to generate profits. How is the terminal market doing nowadays? Now, actually, the oil terminals are doing quite well because of the contango situation, but we will come back on that topic later on. But what we have seen, if we look back, we've seen that the storage industry, the tank capacity, has grown quite fast, by 2.4% per year in Europe. In ARA, which usually stands for Antwerp, Rotterdam, and Amsterdam, it has also increased quite fast, even faster on an annual basis. So, and also if you look here, the growth was especially strong between 2009 and 11, and also the last few years, a lot of new capacity has been added. People are still joining. So now going to the next slide, we see stocks versus tank capacity. Let me see, sorry. But the graph shows the old stocks versus tank storage capacity from all perspective. The more stocks, the more tank storage capacity is needed. So the blue line shows stock levels of oil products in ARA. The red line or the orange line shows the oil tank storage capacity in ARA. And the graph shows clearly that stock level have decreased since 2017 because of a backwardated market. But now, what you also can see, stock levels have increased because of the contango market. So as the market went into contango, stock levels have increased. So that means also good times for terminal operators who are specialized in oil capacity. So going then to the next slide, instead of stock, this graph shows the trade flows in oil products. So the blue line shows the growth rate in the oil products, while the red line shows the oil tank storage capacity. So trade flows have grown significantly since 2005, from 30 million tons per month to a monthly level of 20 tons in 2019. So, and as we have seen before, arbitrage results in trade flows. Of course, arbitrage is not the only reason, but it is an important factor for trade flows, especially for oil. So more important for tank terminal industry is that growing imbalances result in growing trade flows and consequently support tank storage demand. So there's a strong link between gross trade in products and storage capacity. So the blue line on this graph shows the Brent crude price since 2005. The orange line shows the volatility of the daily oil price. So during the financial crisis, for example, in 2008, the oil price dropped and the price was very volatile. You can see that there, the orange line, which was good, of course, for trading purposes. For oil traders, they have made a lot of money. Since 2017, oil prices are moderate with levels between, you can see that between $60 and $80 per barrel. However, what is happening now, due to Corona, due to COVID-19, prices have dropped. It is improving a little bit again, but there's still a lot of volatility. But the volatility, you can see that also here is decreasing a little bit. This graph at the left side shows the crude market, and that the crude market is in backwardation again. So the steep contango that you've seen before in March and April, it has disappeared. So in the recent, with the recent contango, what we have seen, what started in March, it has stimulated the demand for oil storage significantly, as you can imagine. The graph here at the right side shows that the Brent is approaching the level of $50 per barrel again. So we don't know what is going to happen, as there's still a lot of uncertainty in the markets. Now, here we see some other forward curves for gas oil. We see there's still a contango. For jet, there's still contango, and for gasoline, it depends also on the season. So we see it goes up and down. Now, what we have seen in the storage market, if we focus then on the distillates markets, then we can see that prices vary per year or per season, per 6-7 months. They change, but what you see is being impacted. Oil prices are being impacted also by the contango situation. If the market is in a backwardation, storage prices are low. If market is in a contango, storage prices are up again, are high. So that's something that we can see clearly now. And on the short term, we don't expect that the storage rates will decrease significantly. They will stay at a high level, but it will ease something. If we go to the next topic, it's about IMO 2020. IMO 2020, there was a new regulation which has been implemented at the beginning of this year. So it refers to the new marine fuel regulation. And since January, the maximum percentage of sulfur in marine fuels has been reduced from 3.5% to 0.5% sulfur. So in practice, it means that the 3% fuel oil is only allowed if a scrubber has been installed on a vessel. So what happened in the past, if we look back, we can see that the fuel oil, the 3.5%, it's larger, it's categorized as larger than 1%, but this 3.5% was the main fuel being consumed by vessels. Of course, there was also a low sulfur, and this started in 2019, this graph, and gas oil. Gas oil has also been used as a fuel, as marine fuel. Now, what was expected some years ago, 2-3 years ago, was that MGO, just the marine gas oil, would become quite dominant, but that hasn't happened. LSFO, the low sulfur fuel oil, has become dominant. That's what we see now in the figures, and we don't expect that will change. So the VLSFO has mostly replaced the HSFO volumes. So and if you look, the volumes of the 3.5 is about 15 to 20% of the volumes of the LSFO, the 0.5. So, and the MGO has increased here a little bit, but not really significantly. So the estimations are between 5, maybe 10% at the max. But these are only the numbers of the first 4 months. So what also has changed, but that happened already some years, that started already some years ago, that with regard to arbitrage flows for fuel oil, in the past there were many fuel oil flows from Rotterdam to Singapore, but these flows have marginalized because the HSFO is going now directly from the Baltics and from Russia directly to USA. and to other countries. So, and in the future, the demand of marine fuel, we expect it will keep on growing, and most likely the LSFO will remain the dominant bunker fuel, as the growth of HSFO will be limited, looking at the expected growth of scrubbers installed at vessels. So what does it mean for the tank terminal business? It has had a positive effect, we can say. That's what we see. So more tanks are needed to store blend components, residue streams, distillate streams, and there are more fuel grades, HSFO, VLSFO. The ultra LSFO is also still there, and the MGO. There are less fuel oil arbitrage flows from ARA. That means less demand for big fuel oil tanks, but the impact of A is larger than B. And on the long term, as I already said, we expect bunker sales will keep on supporting the tank storage demand in ARA. What's the impact of COVID-19? Now, what we have seen is that there has been, of course, an impact, especially for oil. When the lockdown started in March, people started to work from home. We had to work from home. People start to drive less, and because you're working from home, people were not meeting each other anymore. So consumption of several fuels have decreased. So you can see that clearly for gas oil, for gasoline, consumption have dropped, and also, of course also for jet fuel. So in total, we saw a drop, and these are the Eurostat figures, of 27%. For chemicals, situation is a bit different. The impact has been less, and production levels have been still quite healthy. What we have seen at terminals is that the throughput has decreased a little bit, especially in May and June. But later on, also the throughput levels have recovered to a large extent. Now, looking ahead, what will the future bring us? And then we look at the two topics, the COVID-19 and also the climate policies. So this has still a big impact. Now it's all about Corona, especially if you look to the number of new cases. But climate policy is also an important topic for our industry. So looking first at active cases per region, what is happening? Now, here on this graph, this picture, it comes from Johns Hopkins, you can clearly see where we have the highest number of cases, active cases. So it is in the US, it is here in Latin America, Venezuela, Peru, Brazil, Europe, India, Iran also. And also here in Japan, the number of cases have significantly increased. And also, if you look at the number of global daily cases, it has increased. Today, it was about 670,000 new cases. That's huge. Only in the Netherlands, that's what we heard today, it's 8,700 new cases, and we are only a small country. So you can imagine it still has a big impact on the public health situation and the public health sector, and also on the economy. Not only for this month, but that will last for several months until the vaccination programs will start at a large scale. Now, the table here at the left side shows the real reduction in consumption during the first lockdown from mid-March until mid-June in ARA. So biggest reduction has been in jet fuel. as most of us were not allowed to fly anymore for holiday or for business purposes. Gasoline and diesel have also been heavily impacted, with reduction between 35 and 40%. Naphtha and fuel oil consumption hasn't been impacted at all, at least not according to the Eurostat numbers, most likely because naphtha has become a cheap feedstock for steam crackers because of the low oil price. And if we look to the future for the rest of 2020, and of course numbers are coming in nowadays, new numbers are coming in, but this forecast, or the assumption is that the reduction will decrease, of course, because we are driving more, some people are going to work on a daily basis, but still people are working from home. We fly not that much anymore as we did before, but we fly more than during the lockdown. So the reduction is a bit more limited. And especially for road fuels, the reduction is limited. And although many people work from home, people still have a need to be mobile. And in addition, some people use cars instead of public transport, as public transport is considered as less safe from COVID-19 perspective. But I also observe here in the Netherlands, today I'm in the office, but usually I'm also working from home. But during weekend, traffic is quite busy, and so it seems that people are compensating what they are lacking during the week. That looks like it is. Looking to the future, we expect there's a longer-term corona effect on fuel consumption. So it's expected that behavior will change, but there's still discussion about it, and time will learn. But after corona, more people, what is expected, will work from home. People than before corona. People are more used to online meetings, so that will most likely also have an impact on the number of business flights. And it's expected in first instance that the number of holidays will increase only slowly. And however, as from 2025, we will be back at the 2019 consumption level. So, looking at this graph, and we are back to the calendar spreads. But this blue line shows the 6 months calendar spread for gas oil. If the spread is negative, it means that the future price is lower than the current price. So then you are in a contango market. So that's what we see happening here. What started in March of this year. If the other two blue lines, but the colors have changed a little bit. The other two lines at the bottom are an indication of the price volatility on a daily basis. And MA here at the right side, that stands for moving average. And so an average of the absolute price difference of the last 5 days. So as we have already seen, the contango has disappeared for crude, but also for other products it could be expected that they will move to a backwardated market. On the other hand, if OPEC would decide to change their strategy by increasing the current production cap levels, it could create a contango market again, as consumption is still at a low level. And of course, COVID-19 creates a lot of uncertainty. So here at the bottom, you see then the volatility. In April, it was a huge level of volatility. Now there's still some volatility there, especially if you compare to 2017, where you didn't see any volatility in the market. So talking about climate, the other big topic. Regulations, they are, I will first go to the next slide, sorry. What you see happening climate policy, is a hot topic, and still a hot topic, and will become more hot in the coming 2-3 years. That's at least what is expected. It has an impact on oil consumption via the growing share of electric vehicles. You can see that if you're driving around. So especially in Norway, also in the Netherlands, the number of electric cars is increasing quite rapidly. It's driven also by subsidies. The government is investing a lot in stimulating the market, but it has, of course, an impact on the oil consumptions. So regulations are driving then the growing number of electric vehicles in the EU. So by 2021, the EU emission of the target is 95 grams of CO2 per kilometer, and this is a very challenging target for most car manufacturers. And in case a car manufacturer doesn't meet the target, he will get a non-compliance penalty. So selling electric cars, battery electric vehicles help to reduce the emission of car manufacturers. So what you see happening, the main reason for you see that the car emissions are going down since 2000, but since last year it's going up again. And the main reason for these higher emissions is the growing sales of SUVs. And SUVs, they have higher emissions. So and the CO2 emissions that's from diesel are almost on par with petrol cars. But cars are becoming more heavier, and that's the main reason of higher emissions, what we see happening nowadays. Now, however, in case the target would be met, this graph shows that the emissions will be reduced to a level of 75 grams CO2 per kilometer by 2040. Maybe it goes faster, maybe it goes slower, but that depends on the willingness of the European governments to stimulate the market. Because nowadays, if you want to buy an electric car, it's still much more expensive. But what we see happening via subsidies, via tax subsidies, cars become more cheaper. Electric cars become more cheaper. Now, those two graphs, starting first with the left graph, shows the historic and forecasted volume for gasoline. So since 1998 until 2014, and you can see that here clearly, gasoline consumption has declined because of the dieselization. People were buying, diesel cars became more and more popular in Europe. While as from 2015, gasoline consumption has increased again, mainly because of the reversed dieselization, which was caused by the Dieselgate. This year, we clearly observe a corona dip, let me call it like that, but on the longer term, and it is also expected that the gasoline market will recover gasoline consumption, but on the longer term, you will see a decline of gasoline consumption. Why? Because of the electrification, as we discussed before, and more efficient cars. For diesel cars, at the right side, the diesel consumption has increased until a few years ago, but started to decline because of the reverse dieselization, because of Dieselgate. And also here, of course, we have observed a corona dip, a corona effect. But in addition to the reversed dieselization, electrification and also more fuel-efficient cars cause a further decline in diesel consumption for cars. However, it is expected that heavy vehicles like truck and buses will remain to consume diesel. So that means also by 2040, there will still be a large amount of diesel consumption. Now, until now, we have only looked at the demand side, but supply side is also very relevant. So the black line here shows the refinery output since 2000, while the blue line here shows the demand of oil products. The gray bars show the difference between production and consumption. So this graph shows that overall there's a surplus of oil products in Northwest Europe, or in Europe, and EU, which means that the EU is a net exporter of oil products. For example, Northwest Europe exports huge volumes of gasolines. But if refineries would be closed, output will go down and imbalances will change. And within Insights Global, we usually use 3 scenarios: the good, the bad, and the ugly. So the good means no refinery closures. So the good is from refinery perspective. So no refinery closures and healthy utilization rates. Bad means that some refineries will be closed, and but still a low utilization rate. And ugly means that more refineries will be closed and an average utilization rate, because as many refineries will be closed, it will have a positive impact on the refineries that still are producing the oil products. But for imbalances, it is important also, of course, to look at refinery scenarios. You should not only look at demand scenarios. Now, looking to imbalances, last summer we published our annual ARA Oil Tank Terminal Market Outlook report, and these numbers are from this report. But as said, it is expected that gasoline and diesel consumption will decrease. So it will of course consequences on the imbalances for Northwest Europe. So, for example, for gasoline, currently Northwest Europe has a large surplus in gasoline, and for example, Port of Rotterdam is exporting huge volumes of gasoline to the US, to West Africa, and also to some Asian countries. But it is expected that gasoline consumption will decline faster than gasoline production. So gasoline consumption will decrease because of the electrification and more efficient fuel cars. So consequently, because the surplus and because the gasoline consumption is declining faster than gasoline production, surplus in gasoline will increase, and so therefore there will also be more exports in gasoline. For diesel, it's more or less the other way around. So currently diesel has a deficit in Northwest Europe. Consumption is expected to decline faster than production, and consequently deficit will decline and will ultimately switch from deficit to surplus. So nowadays Northwest Europe is importing a lot of diesel volumes, but that will change. Now, what is, looking to the outlook, the conclusion, what can we say? Some takeaways. Now, there's still a lot of uncertainty in the market. It's to some extent it is supporting also the value of storage for traders. Contango, however, is disappearing, but there's still price volatility. Chemical consumption is not significantly being affected, and chemicals, we use it continuously in our daily life. Look around, I don't know where you are, but you see everywhere, you see chemicals, and we use it on a daily basis, and usually we are not aware of it. Looking at the fuels, with regard to the road fuels, so if emission targets are met, then light end storage is expected to grow. Light ends, then we are talking about gasoline, but also naphtha. But gasoline storage is expected to grow, and actually more or less reinforcing Europe's role as a global gasoline supplier. So looking to gas oil and diesel storage, it is based on what we know now. It is expected to decline as import volumes will go down with demand. So looking to the short-term future to 2021, it's uncertain and there is some upside, but also some downside. Medium term, we also see a mixed picture, especially for diesel. The future doesn't look good, but for gasoline, it's not too bad. And for chemicals and other fuels like biofuels, veg oils, and maybe also on the longer term, methanol, ammonia, and of course hydrogen. These three products are also set to be an energy carrier, and that will become very important on the longer term. So I think this was the last slide. So if there are, I took a bit longer as I expected. Sorry for that. Now, if there are any questions, I don't know. I need to check the chat. You can still ask questions via the chat. That is, of course, possible. I don't see any questions coming in. No. Okay, then we will send you a slide pack and also recording, and hopefully we will be in touch later again. So thank you very much for your attention, and hopefully we'll be in contact, and enjoy the rest of your day. Okay, thank you. Bye-bye.